Hi everyone, welcome to this month's webinar about cash flow management. A few people are still coming in, but we'll make a start in the interest of time anyway. Just in terms of using Zoom, again, if you've got any questions, please feel free to add them into the chat or Q&A boxes. I'll have a look at those at the end of the webinar and answer those questions. If you need to leave, there's a red leave button. Just remember that this webinar will be recorded, so we'll send those around via email probably in the next couple of days. And yeah, as I said, if you feel free to ask questions, I will get to those at the end. Just to introduce myself, my name is Warwick Maddox. I'm the director here at And Robin, and we're running these monthly webinars for all our business owner clients and people in our network. And it's a good way for us to kind of share knowledge, and we'll be changing the topics each month as well. So hopefully keeping them kind of fresh and interesting. I always like to start off with a thought of the day. So this one's from Chris Coca, who you may not know, but he said, "The fact is that one of the earliest lessons I learned in business was that balance sheets and income statements are fiction, but cash flow is reality." So we've probably all got experiences of pulling out our profit and loss statement or our balance sheet, and it's saying one thing and our bank balance saying another. Very common question we get asked by business owners. Yeah, it's a fitting statement, I think. So keeping the cash flowing, five principles. The way we like to think about cash flow is that without cash, businesses won't survive. By all means, temporarily, sometimes we need to prop up our businesses and lend money in or get investors on board or whatnot. But that's not sustainable for the long term. So we want the business to stand on their own 2 feet, and cash flow drives that. It's important to understand your cash flow drivers as well. So we'll go through that in a little bit of detail today. But the cash flow drivers in each business is different. So what drives cash flow in my business versus in your business might be quite different. Managing cash flow is all about your processes. So we'll talk a little bit about that as well today. There's a few kind of things you can do to minor tweaks that can really bring about big improvements in cash flow and cash positions. Treating the symptoms of poor cash flow without fixing the underlying causes doesn't really work. And this goes for a lot of things in business, right? Sometimes if we put a band-aid on the symptoms, it makes us feel better or the business is stronger temporarily. But generally, there's a long-standing underlying cause which is causing those challenges. And we need to be prepared as business owners to make process changes as well. Again, we'll talk a little bit about that in more detail. The goal being that we're improving our cash flow and improving our cash balances so that we can look at things like reinvesting or paying profits out or wages out to business owners as well. So the agenda for today, I'm going to talk briefly about the difference between profit and cash, which I touched on in the thought of the day earlier. We're going to talk about what the working capital cycle is, a bit of a definition, and how it works. Also the cash conversion cycle and how they kind of fit together. Some plans for how to improve cash flow, the 7 key causes of poor cash flow as well. We're going to talk about next steps and how we might be able to support business owners with improving cash flow. And then, as I mentioned at the end, we'll go through Q&A as well. So the common question we get asked by business owners is, why do I have a profit in the business, but my cash balance is staying the same or maybe even going down or not increasing by as much? At the end of the day, profit and cash are not the same thing. We'd like to think they are just to make things simple, but there's a lot of things that go into cash and or profit that don't necessarily correlate with each other. So a profitable business can go out of business because it's starved of cash, which we mentioned earlier. A business making a loss can survive because it has access to funds from investors or financiers. So what we see a lot of the time with business owners is if the business is making a loss, then the business owners are the ones putting in their personal funds to prop that business up and pay the obligations, whether it's the ATO or suppliers or make payroll and whatnot. Or the business might have external investors that are continuing to put in more funds and money as well. Um, Bit of accounting 101. So profit is the difference between our sales over a period of time, less the cost of stock and other expenses, excluding GST. So whenever we're looking at profit and loss, it's always on a GST exclusive basis. A question I get commonly, because that GST is not our money. It's the money we hold or collect on behalf of the ATO. Whereas cash is all cash amounts coming in versus cash going out. So that's a fairly straightforward one. And the main indicator of cash flow is our cash at bank balance. If we see the cash at bank systematically going up, that's a good sign. A few things that impact profit versus cash. So our GST, as I mentioned earlier, so if we collect GST and we pay GST to the ATO, it definitely affects our cash balance, our bank balance, but it does not actually hit our profit and loss. As I mentioned earlier, the income and expenses is on a GST exclusive basis. Um, in addition, loan repayment. So if we've got finance for vehicles or for business working capital and whatnot, those repayments of loans, so the actual monthly repayment affects our cash balance. It reduces our cash balance, but it doesn't impact our profit. The caveat to that is the interest component does actually affect our profit. So what we're talking about there with the loan repayments one is more the principal component. So the principal component of the repayment will affect the cash balance and the balance sheet, but it won't impact on the profit and loss, whereas the interest component will. We get a tax deduction for those interest components. If we buy assets, so if we buy vehicles or plant and equipment or even stock inventory, that reduces our cash balance on the basis that we're not financing that, but it doesn't impact on our profit. The difference is if we skip forward depreciation. So the depreciation or the spreading of the wear and tear of that asset over a period of time, that does reduce our profit and loss, but it doesn't reduce our cash balance. So you can see there's a timing difference between money we're spending on assets versus the deduction we get for the depreciation over the effective life of that asset. So that's why those two kind of work in opposite. There's that timing delay. And same with cash received from the sale of assets is the reverse. So we're getting money for selling assets, again, whether that's fixed plant and equipment, depreciable assets, or inventory, but it's not impacting on the profit and loss. So there are a range of reasons why the cash balance and the profit aren't the same. And generally speaking, I hardly ever see the profit and the cash be exactly the same in a business. Working capital cycle. So just wanted to run through this briefly. So the working capital cycle is the link between profit and cash. So the timing of that. So for example, the easy example is a service provider like an accounting firm like ours. What happens is we make sales and send out an invoice to a client. At some stage in the future, that client will pay those invoices. So that's the accounts receivable or the trade debtors. And then that gets recycled into generating more income. So you can see that between making a sale, sending out an invoice, and then collecting the cash on that invoice, there's a delay or a timing delay between those three things happening. So if we've if we've completed a piece of work today and we send out the invoice in a week's time, and the client pays in a week after that, then you can see that working capital cycle is 14 days or 2 weeks. On the flip side, for a retailer, a manufacturer, a wholesaler, someone who's buying and selling goods, it's a little bit more complex. So what happens in that space is they will purchase inventory or stock, generally pay the supplier for that amount, um, convert that into some form of work in progress or goods that are ready to be sold to the end customer. The sale it happens, an invoice is sent out if it's on credit terms in particular, and then cash is collected. So you can see there's in that same process we went through with a service provider, there's a lot more steps. So the time frame can be a lot longer. And the example I use for quite a long time frame could be something like a builder, between achieving certain milestones, building a house can be weeks, months, up to years to get through this working capital cycle. And this is oftentimes why we see a lot of businesses in the trades industry really struggle with cash flow because that has to be really well managed if that time frame is very long. If your working capital cycle is quite small, it's quite easy to manage or relatively easy to manage, I would say. But if that process is long, then you've got capital or cash tied up in this cycle for a lot longer periods of time. You might be more reliant on bank finance to help you through that process as well. So just a bit of an example of a cash conversion cycle. So let's just say day zero today, we buy stock from a supplier. This is under like a retailer or a wholesaler type arrangement. Let's say we have 35 days to pay for that stock from the supplier. So money goes out in about 35 days time. Um, but let's say it takes us another 30 days to actually sell those goods to our customer, to the end customer or the consumer. And then let's say they're on credit terms and they've got they pay on average another 45 days later. So you can see from when we first put in the order for stock through to us getting paid from the customer or the client. In this example, is 110 days. Now you can see that it's split up into two parts. One is the period that we hold the stock, and one is the period that we've made the sale and are collecting on that sale as well. So there's kind of two facets there. The average stock holding being 65 days and the average receivables being 45 days. So your average receivable, the one on the right hand side, is what you call your debtor days percentage or your receivable days. And your stock holding would be your inventory days or your inventory turnover rate. But you can see here clearly that it's taking 3, almost 4 months to get paid for that transaction. And this is what businesses in this space need to kind of work out ways to manage through that period because during that period you might have BASs due, you've probably got some pay runs due, you've got other suppliers to pay, you might have subscriptions coming out. So there's money going out of the business, even though you haven't got any money coming in for that period. So it makes sense that the shorter this cycle is, the better the liquidity in the business. So when we talk about liquidity, it talks about how liquid the business is or how free flowing cash is. So if you've got high liquidity, it means money's coming in and going out at a fairly regular rate. So really, all things being equal, the shorter these cycles are, the safer the business is. There's other things to factor in, but from a cash flow perspective, the shorter that lead time, the less there is to manage from a cash perspective. So the big question is, do you know your cash conversion cycle, and do you know how to calculate it? The other thing we like to do is say, okay, well, if your cash conversion cycle is currently, say, 60 days, how do we get that down from 60 days to initially say 55 days. Because even a small increase or a small shortening of that cycle of 5 days doesn't sound like much, but when you average that over all of your customers, all of your revenue, that can be quite a sizable improvement in cash flow. And I think we've got an example here as well. Okay, so this is a manufacturer, so someone manufacturing goods. So we've got their summary financial data on the left-hand side. So let's say they've got, this would be on an annual basis, let's say. So let's say they've got annual sales of $1.5 million. Their cost of goods sold, so that's their product costs, are 955,000. They've got overheads or fixed costs of 220,000. Their accounts receivable on average sits around 210,000. Their inventory sits at about 160,000. That'll be an average position. And their accounts payable on average sits around $95,000. So when you plug that into the calculation, you'll work out that the cash cycle for this business is 76 days. So what that means is from purchasing products through to generating the sale and collecting on that sale is about 2.5 months, I should say, 76 days. Now, if we happen to reduce the debtors, so the accounts receivable, so if we got our accounts receivable to pay 9 days quicker than what they do on average, and if we got the inventory to sit on our warehouse, let's say for 6 days less, so we sell it 6 days quicker, and we receive the payments thereafter 9 days quicker. So effectively shortening the cycle, the cash cycle by 15 days. So from 76 down to 61 days. Over a course of a year, that would actually increase our cash position by $52,000. And the reason for that is the quite high increase is because we're generating $1.5 million of sales a year. So you can see that the higher the figures are that we're working with, the higher that increase in cash position is going to be. But again, this is just a reminder that you don't need to make large scale changes. You don't need to bring the cash cycle down from 76 down to 30 days, for example, which is probably unrealistic, to have a sizable material increase in cash position. And I presume that this business could do quite a bit with $52,000 of cash. One of the benefits would be just reducing stress. So oftentimes we find with business owners, they can actually, if they've got cash flow issues, they do get worked out in due course, but it's the stress and the mental toll that it takes on business owners that's probably the biggest win out of these changes as well. So what I'd recommend is definitely calculate your working capital and your cash cycle days. How long does it take on average to get from starting a product purchase through to selling a product or service on average? That would be a really interesting calculation for all business owners to be aware of. So in terms of cash flow improvement, 4 actions that we would recommend is to understand your cash flow better. So if you don't already, we recommend business owners have an annual cash flow forecast. Best practice would be to set a cash flow forecast for the year, and it's probably a good time to do it because we're coming into the new financial year. So you would set your cash flow forecast for 12 months, but what we'd also recommend where possible is reviewing it every month or every quarter to see if it's still accurate, because as we know, things change in business, things are always constantly moving. Best practice would be not just to do it at the start of the year and set and forget. Sometimes we see people build a cash flow forecast or a budget at the start of the year more as a box to check off, as something their accountant wants or the bank wants or whatnot. But best practice would be to review it and tweak it throughout the year. So you kind of always got that largely live version of the forecast. Importantly, incorporating your cash flow forecast into your accounting software. So if you're using Xero or MyOb or QuickBooks, generally speaking, they have the ability to actually put the numbers into the system. because that'll allow you to compare the actual financial performance versus the forecasted performance. So we've just finished the month of May. So you would compare your actuals for May versus what you'd forecasted for May. And you might do it over a longer period, a year-to-date version as well. And then you work out what's working well and what's maybe not working so well, where your costs have blown out, or where your revenues dropped, or on the flip side, where things are going really well. Um, Setting SMART goals, so specific, measurable, attainable, relevant, and time-bound goals around improving your cash flow plan. So if you've got a forecast and you've got your working capital days and your cash cycle days calculated, it's about what small things can we change to make those gradual reductions in those cycles. Again, it's not about doing big, large things most of the time. Often it's small tweaks. So can we chase our debtors more actively, for example? And have someone independent hold you accountable. So whether that's us or a business coach or whatnot, we tend to find spouses, unfortunately, probably aren't independent enough to hold us accountable. So it's good to get a coach or someone on your who wants the same thing as you, wants your business to improve, but is not involved in the day-to-day running of your business. Um, so we're going to jump to the 7 key causes of poor cash flow. What you'll probably find is that back to our earlier point around improving the cash cycle, you might have a couple of these 7 that you want to focus on as those SMART goals for improving. I'm not going to go through too much the agenda of these. I'll just jump straight in. So the accounts receivable or trade debtors process. So this is around how you're invoicing for your sales. Are you providing the ability for customers to pay electronically through a link or a credit card, to have the ability to pay that as easy as possible? Or does someone need to log into their internet banking, get the bank details right, manually putting it in and pay you? So it's prone to error, and it's a lot of effort. Whereas if you've got a link that they can just put their credit card in, that might make payments a lot quicker. Are we chasing up our accounts receivable on a regular basis? For the tardy clients, we might want to talk about using a debt collector to try and recover as much of those invoices as possible. Just those kind of things. Sometimes we might have an admin team member who's following up our accounts receivable process, and they're not getting through to the client, and might require a business owner or someone more senior to have a conversation with those clients. Maybe someone who's got more of the sales experience or experience with the delivery of the product or service. So tweaking those processes. So it's always good to review what your accounts receivable process looks like. On the flip side, accounts payable process. So these are your suppliers that you're paying. Sometimes we see business owners who they receive an invoice from a supplier and they pay it straight away just so that it's done and they don't have to worry about it. There's nothing wrong with that, but the problem is that means you don't have that cash to use in the interim. So if you've got suppliers that require you to be paid 30 days after the invoice is sent, you want to be trying to pay them as close to the due date as possible. So you want to avoid trying to go over those because you want to manage those relationships with your suppliers, but you don't want to pay them too early either, because effectively that's your cash flow that you're giving up to provide to your suppliers. And if you're prone to forgetting to pay those invoices, then it's just about trying to build in that process in your accounting software so you can, on a regular basis, whether it's weekly, monitor what's due when, so you don't miss any of those due dates. Part of this process might also be negotiating better credit terms with your suppliers. So oftentimes, if you're using suppliers for a lot of purchases, you might actually be able to negotiate a longer term payment profile. If you're on 30 days, you might be able to get 60 days, for example. So reviewing that process is important as well. Inventory process, so ordering system. So what this is talking about is making sure we don't have too much inventory, or the right amount of inventory in our warehouses and our shops at any one point in time. We want to try to avoid having stock or inventory that's likely to become obsolete or out of fashion, or if you're talking about food, out of date. But you also want to make sure that you've got enough inventory to actually be able to provide the sales that your customers want. So um, it's a bit of a fine art trying to manage that perfect balance. Sometimes you might be able to have a situation of inventory management where you've got just in time. So products might be able to be shipped into your warehouse right at the last minute before it's needed for a sale. Um, but it's important to review your inventory processes because we want to make sure that we're not writing off too much inventory as wastage or obsolescence. But also, we don't want to be turning customers away because we don't have the stock on hand as well. So, always good to do a bit of a review as to how you're actually managing your inventory. Debt capital structure. So this is talking about what finance you have in the business, whether it's debt or whether it's equity, and talking about how money gets into the business. So we want to make sure that we have the debts. If we're talking about debts, we want to make sure the debt is aligned to the actual requirement. So, for example, if you've got if you've got long-term finance needs, for example, period over multiple years, you want to try to avoid having short-term finance options like payday loans or personal loans or those high interest kind of credit cards, overdrafts, that kind of thing. There's nothing against those loans. You just want to make sure that the term of the loan or the term of the finance fits with the requirement. So, for example, you might have a car finance that's over 5 years. That might fit really well with when you're looking to upgrade the car for something new. Whereas if you're looking at kind of finance just to bridge a gap for a short term, you might be willing to pay higher interest rates for an overdraft and whatnot. So with this, what I'd recommend is you talk to a good commercial finance broker who can get the right products for your business needs as well. They will try to match the requirement in the business versus the product, the finance product. Um, uh, on the flip side, with equity, if we need more money within the business, we don't want to just jump to issuing more equity or more shares to investors and whatnot as well. So this is just a reminder to review how money is getting into the business from a debt or a owner's equity perspective, and just making sure we're using all the options we can and that they fit with what our actual goals are for that money. Overheads are too high, so we always recommend probably every quarter or every 6 months is reviewing overheads. Some of these you can't control, some of them you can. Things like rent, marketing. Are we getting a return on investment on our marketing? Subscriptions is a big one. They can creep out of control. We end up using or paying for software that we're not using anymore. User licenses as well. Sometimes we might have people that have left the business, but we haven't downgraded our software. I know that's big in the AI space now with people using multiple AI platforms or not using them but still paying for them. So it's good to run a bit of an eye over the profit and loss for a quarterly or 6 monthly period, and cutting back some of those costs as well. Again, there might be opportunities to negotiate discounts with insurers and stuff like that if we bundle things together and whatnot. So always good to do a review of your overheads on a regular basis. Gross profit margins are too low. So what we're talking about here is the difference between our sales revenue and the cost of the product or service, so the direct costs. So these are the costs that will generally go up as you sell more. So in the example of manufacturer. That will mostly be the product costs, could be a bit of labor as well. Generally speaking, if the gross profit margins are too low, it's usually one of two issues. One is your prices aren't high enough. So if you haven't increased your prices due to inflation every year, you're losing money every year. So you want to make sure you're doing price increases at least annually, because all your suppliers are probably increasing their prices. The cost of living and cost of everything's gone up dramatically. So one is too cheap pricing, and two is negotiating better deals with suppliers as well. So again, if you're buying a lot from certain suppliers, then you might be able to negotiate better prices and better credit terms as well. So that's generally where the margins come in. Or if you're using a lot of labor to produce a service or a product, are you potentially not being as efficient with that labor to get the product or service delivered to the customer as well? I think the important thing on this is there's many businesses that don't actually track their gross profit margins as well. So the first step for those businesses would be to actually track it in your accounting software, so you can what gets measured gets managed. And the last one is sales levels are too low. So this is where scale comes into place. So as we know, when we're starting out a business, generally the business is not at the level we need it to be to support the overheads or the costs that we've got. In which case we need to grow beyond that level to get a certain level of sales. So generally what you'll find is below a certain point, you're potentially losing money or the profit margins are very low. And then at a certain point, then you start actually for every extra sale or revenue generated, it gets a lot easier. You just seem to be making almost not pure profit, but the profit margin for each dollar of sale thereafter is a lot higher. So it's important to know where that point is for your business. And when we're talking about sales levels being too low, again, part of it is pricing. So it might be that you've actually got the right number of sales, you just don't have the right pricing. And part of it is growth. So investing in advertising and marketing and referrals and delighting your customers so they come back, or more sales. If you are interested in this area, I definitely recommend going to our website and reviewing the recording on the 7 ways to grow, which we did a couple of months ago. These are the 7 main ways to kind of generate more sales. So definitely worth watching that. Okay, so there's a lot of information there. How we at Robin can help with some of this stuff. So there's a couple of ways. So one of the ways is we actually have a meeting, a 90-minute meeting called a cash flow and profit improvement meeting. And part of that is we actually go through your numbers and build up a bit of a report, and some goals as to what to action. So you get something tangible out of that meeting, which we charge for $600 plus GST. We can actually help you with your cash flow forecasts as well. So we do a preparation on the front end, and reviews with you to make sure it's correct, starting from $3,000 depending on the complexity. And we can also do cash flow management coaching, which is a kind of a 12-month coaching program, which can go beyond 12 months. It can go on indefinitely, but to help business owners to design and maximize cash flow on an ongoing basis. And again, depending on the complexity of the coaching, we do that from $3,600 a year up again. So if you're ever interested in any of those areas, please reach out. We'd be happy to help. I think the next steps for everyone on the call is identify what your next 3 actions are. So what your takeaways are. I guess the options are to do nothing, to retreat and put your head in the sand, take normal amounts of action, so kind of continue doing what you're doing, or take massive amounts of action. depending on how much time you've got. So you need to kind of try and work out from this webinar where you want to focus. We would always recommend on focusing on one or two things at a time. So as business owners, we can spread ourselves quite thin with having to do everything, wearing the 10 hats in the business, so to speak. And what we find is a lot of things just don't get done. They're good to haves, but we never get around to them. So what I'd recommend is work out what your one to two main priorities are in the business, whether it's cash flow management or otherwise, and focus on those and nail those, and then look at moving on to the next kind of projects as well. And that way you'll find over time a lot of this stuff that you've always wanted to do gets implemented. We always like to finish with a thought of the day as well, from David Tang. The three most dreaded words in the English language are negative cash flow. Um, if you look at the ASIC's statistics around why businesses don't last. Many don't make it through the first year. There's a large proportion that don't make it through 2 years, and an even higher percentage that don't make it through 5 years. Um, at the end of and even when we talk about all the news media, we hear about businesses being wound up and liquidated and liquidators coming in. It generally all comes back to some form of weak cash flow. We're seeing a fair bit of it at the moment with challenging economic conditions. So the point of that is the more you can get a handle on measuring and managing the cash flow and the cash flow cycles within your business, the more that puts you in good stead for building and maintaining a sustainable business into the long term. That's it from me. There's a fair bit of content there. As I said, I will send around the recording in the next couple of days. But does anyone have any questions they want answered while I'm here? I'm just having a look at the chat box. There's nothing in there at the moment, but if you've got anything, please send it through. If you want to chat about your own business and cash flow management, again, feel free to. You'll get the email come through about the recording. Please feel free to just click respond, and that'll come through to me as well if you want to talk specifics.